Hello and welcome to Real Deal Investing. I'm Jerron Kelley, your host. I'm a real estate attorney as well as a multifamily investor. My co-host, Larry Mastropieri, who is also a multifamily investor and a real estate broker. And today we have two awesome guests for you. We've got Emmanuel St. Germain and Jared Perlman. Both are loan officers at Choice Mortgage, and they are also two of the owners and senior officers here as well. So welcome, guys. Good to have you.
Thank you for having us.
Thanks. Yeah, of course. So we are excited to have you here today because there's so much change that's been happening in the lending world, both for traditional financing as well as for investor financing. So we want to talk about some of those programs that are out there for investors as well as regular homeowners, conventional homes as well. A lot of people are getting their pockets stretched, trying to buy properties, trying to get into deals. So we'll get into that. But before we do, I just want to kind of get a little bit of background about each of you. Not only are you two guys two of my best friends, two great guys I've known and hung out with for a good 8 to 10 years now or more. But why don't you give the audience a little bit of a background about how you got into the lending business, where you're from, just a quick background.
You want me to go first?
Yeah.
Age before beauty.
Yes.
I'm French Canadian. I was born in Montreal, and I moved to the U.S. when I was 7 with my mom, and I grew up about an hour northeast of Boston in a town called York, Maine. And I have an adoptive dad who is a loan officer, and that's how I was introduced to the industry. Now, albeit I had no idea whatsoever what the industry was like. And I don't remember ever, in terms of being in his office, understanding any of it. The only thing I do remember as a child was that there was this immense amount of flexibility that my dad never missed any football game. I was sang in a choir. He didn't miss anything I ever had because of that flexibility. And so when I had the opportunity to get into this industry, which is, I moved down here in 2005. And in fact, the building that we are in, ironically, is where I had my first job here. And I worked for Ameriquest, which was a subprime mortgage company. Now, Ameriquest, for all of its faults, was actually really fantastic at training. And they had this opportunity where they would take people off the streets and they would teach you how to sell the benefits of a mortgage and how to sell. Now, granted, we were selling some really awful products. I remember selling what's called a 228 with a 3-year prepay. So essentially it's a 30-year amortized loan, but it's only fixed for 2 years. But you had a 3-year prepay. So you essentially were forcing people into an adjustable in the last year. So the product itself was really bad. So it was, you can understand why they went out of business, and you can understand why things weren't so great. But it's how I started. And I remember I left that company about 10 months into it. One of the guys that, ironically, I just pre-approved him to buy a house in Texas, but literally one of those guys that worked for me, because at this time I was like a team lead or something, he got fired via FedEx. And I was just like, I'm not working for anyone who does that. Like, if you don't have the sense of decency and human compassion, if you're going to let someone go, you do it the right way. And for me, that was a tall tale sign that it was time to go. And so I rode out for the next couple years of the subprime world and survived the crash, barely. That was, I know that you guys were around for that too. And
when did you get started in the industry? 05, 06?
05.
05.
January
okay,
of 05.
So when things were just ramping up, well, had already been ramping up, but really hot.
Yeah.
Okay. So you experienced the last part of the ride up.
We could write a loan simply stating that you're a dog walker making $10,000 a month.
Stated income, really.
It was, yeah. We had about a year. I'd say we probably had 2.5 years of the Wild West. Mm-hmm. And then it got real difficult. And so of course we went through lots of different things as I think it was called implode.com. Implodometer. There was a website that literally we would look at every single day, and you would see these banks going out of business.
Oh my gosh.
Now, as owners today, this is something that we have to worry about, because the way that as direct lenders, we're lending our money. Yes, it's on warehouse lines, but it's our responsibility. And if we don't sell those loans off to different aggregators, and we're stuck with that. And I remember back then it was, it was happening every single day. A bank was going out of business. So it was really rough, but there was a lot of amazing learning lessons, and I'll share some of that stuff with you in just a few minutes. But Jared, why don't you go ahead and so I don't hog the mic here.
You took a journey. I don't know where we started, but I guess it was background and where we got into the business.
Yeah.
And, so my background's a little bit different than Emmanuel's. I'm from down here in South Florida originally. I'm a 4th generation Miamian, so you don't find a lot of us down here.
Awesome.
And different parts of my family have been in real estate in different capacities. So my dad's side, they owned hotels on Ocean Drive almost 100 years ago, and boy, I wish they still had them. And I
didn't even know that about you.
Yeah,
that's crazy.
He came over and somehow weaseled his way into percentage ownerships in like all those old Ocean Drive hotels.
Amazing.
And could have been the king of Ocean Drive.
Could have been, yeah.
He had the foresight. And my stepfather's been around for 30 years of my life, and his family were all developers. So there's a big community down in Miami called California Club now. It used to be called Perlman Gardens. So, we had a lot of development down here. And because of that, of course, I absolutely never wanted to get into real estate or anything touching it. Everyone said, that's the family legacy. That's where you go. And I'm like, no, absolutely not. I'm not doing it. So, went to college went to University of Florida, got a degree in finance, left school, decided, all right, I'm going to be a financial advisor, went to work for a group with a massive multi-billion-dollar book, and thought I was going to learn all this, thought I was going to learn everything you see in every Wall Street movie. And I think it was 7 weeks in, I walked into my boss's office and I shook his hand and I said, hey, thank you. This has been the greatest internship I've ever had. And he goes, didn't we hire you full time? Nope, this was definitely an internship. I got to go back to school. It was terrible. It was so slow. It was so monotonous. It was a lot of paperwork. Not to say we don't do a lot of paperwork now, but it was all paperwork. There was no action to it. So went back to school, went back to get my master's, realized that was even more paperwork and even more slow. And decided, you know what, this isn't for me. I'm done with school. I got my degree. I don't need an MBA to do what I want to do. Trying to figure it out, and decided to do what everyone did back in 2012, raise a bunch of money and start an app company. Doesn't even matter what the app did. Realized very quickly after we got the money that we didn't know how to program. But, we knew how to sell. And that folded, and just trying to figure out what I was going to do next.
We're victims of your own success.
Yeah, yes, exactly. Right. If I knew all the stories I know now, just keep raising money and become a billionaire. Maybe I would have done that.
Ponzi scheme, biggest Ponzi scheme.
Yeah.
South Florida history. Yeah.
I guess they
could have been that guy.
I don't look as good as Elizabeth Holmes in a jumpsuit, so it might not have worked out so well for me. But trying to figure out what I was going to do. 22 years old. I had a cousin in the business, still in the business, who's good friends with Emmanuel. And he introduced me actually at a football game, tailgating, 7 a.m. Might not remember that the day we met Emmanuel, but
is that the end of the tailgating or the beginning?
I think it was a UMFSU game.
Okay,
so you can imagine what it looked like.
It was a UM-UF game, of course, because I went to the University of Florida. But it was okay. I didn't know what the guy did, at least, but. Yeah.
So you met Emmanuel there.
So I met Emmanuel there, and within a couple of weeks, I started, showing up at the office and just trying to figure out, he was working with my cousin at the time, and trying to figure out, what is this business? Is this something I'd be interested in? This is 2012, when things are now ramping back up after the crash. So I was very fortunate to come in after all the regulation, after Dodd-Frank, and my first taste of this to be how difficult they made it to lend. And I looked at the landscape, and I saw an industry where people were very successful that had left. We had a severe shortage of loan officers. We had a lot of inventory. We had really good rates. I looked at an industry and I was like, oh my God, this is incredible. And the cherry on top of the sundae, I'll probably get the stat wrong, but somebody showed me like 2 weeks into me trying to figure out if this was the business for me, that the average age of a loan officer is like 59 and a half years old. Wait, what?
Wow.
There's nobody servicing all these millennial clientele. There's nobody trying to come up and figure out how to do this with any sort of newfangled system, for lack of a better term. I mean, I'm not a programmer by any means, but you bring a little bit of technology into something that's so paperwork intensive, and you really smooth out the wrinkles very quickly. And so I realized, at that point, that this was a great business to get into. This was a great opportunity. Emmanuel, who at that point had been doing it 7-8 years, took me under his wing and showed me the old school ropes, how to diagnose guidelines and deal with clients and, bring them in the door. And it's been a fun ride ever since.
That's Great. Well, I remember when I first met you, you were a really young buck. I mean, you're still compared to me, you're a young buck, but I mean, you were killing it from early on. You really, you hit that younger demographic, and you were bringing lots of loans. And I'm sure people of all ages, but really those kind of your friends from college that were out there and they were getting married and buying homes, and their friends and their friends of friends, and both of you. You've always had a good book of business, even before starting Choice Mortgage here and building the business. It's you had your own book of business. So kudos to both of you on that. Let me ask a couple dumb questions from a layman's perspective. I think I know the answers to these, but I think these might be common questions that people would have. What is the difference between a loan officer and a mortgage broker, and what would you consider that you and your team are?
The actual term is that we're licensed loan originators.
Okay.
I think the question of what you're asking is what are the different landscapes of lending? And then what I would say is that the lowest barrier to entry would be what's called a mortgage broker or a mortgage brokerage firm. And then you have two types of what are called correspondent lending. You have what is called non-delegated, where I would take your loan and it would be underwritten somewhere else. When you have delegated underwriting, which is where we employ our own underwriters in-house. Obviously, the greater level of risk, the greater level of potential premium that you would make, or revenue, if you want to say it that way. And then the last would be like a retail bank, like a depository institution.
The Wells Fargos,
would be the Wells Fargos.
Americas.
That would be your final stage.
Got
so
it.
there's really four. So we started this company right away going straight into the delegated model, which is not normal at all. Normally people start at the bottom and they kind of work their way up. But we already had a model in place that we liked and we knew was the right fit for us. And in fact, we have, a part of, we use EOS. I don't know if you're familiar with EOS, but it's Entrepreneurial Operating Systems. And it's a form of training and management style and leading a group in one of our, with 5-year, I don't know if it's 3 or 5-year goals, but it's to acquire an FDIC. That is part of truly get there. So one of the things that makes our partnership so good is Jared and I, although we're best friends and get along extremely well, we take totally different paths. He's I'm the wild, crazy thinker, and I come up with these weird ideas, and I say, Jared, you got to figure out how to implement this. And he goes, no, that can't be done. And I say, figure it out. And we go back and forth and we meet in the middle or somewhere. But because we kind of stay in our lanes and we're not, most companies are typically, a lot of mortgage companies are just built by a couple salespeople, and then they don't necessarily put into place the systems and processes that truly think about the client experience, the referral partner experience, and the employee experience. So for us, that's really been paramount.
That's great.
You mentioned becoming or getting your FDIC. What does that look like? How would you do that?
So I don't know
Super
all
curious.
the details just yet. What I did find out, though, we were approached already by someone who had acquired 2 or 3 FDICs outside of Chicago, and he wanted us to come in and basically us to be their lending arm. And it was the first eye-opening moment for me, anyways, as an entrepreneur, realizing that you would think, because when you think bank, you're thinking Bank of America, Wells Fargo, you're thinking the big boys that have all this stuff, right? But they've got tools and they've got access to some really cool toys that they can play with. They just don't necessarily know how to lend the way that we do, right? They're in banking. They do all sorts of different things. They're regulated differently. The largest advantage for us in terms of being able to do it, I would say, is access to capital. Right, you never have access to capital. Like the amount of money they can borrow continuously against the Fed or whatever they're trying to do. Then on top of it, for us would be you could do licensed business in all 50 states. So without needing to get licensed, we can hire loan officers that don't have to be licensed. So there's some serious advantages in terms of your growth model and trying to get to that next level.
So you wouldn't be like a depository institution per se. You'd be able to lend against.
No, it would be. So you would be attached to an actual bank at that point.
Got it.
So typically what you have to do, like we wouldn't be able to own it by ourselves. We'd have to bring in a partner who has all the banking regulations and we don't know what we're doing.
Yeah.
That's not.
You're like a regional bank.
Yeah, the
on some level.
traditional model is
Yeah.
you find a bank in a small community somewhere. There's across middle America, there's, the Bank of Smithville, the Bank of, middle of Nowhereville. And they don't have that continuous business coming in because they have the 500 families in their community, and they have their deposits there, and they don't know what to do with them. And traditionally in American banking system, you need to take that money and you need to lend it to create revenue for the bank. So even though these banks are established, they've been there 100 years, they have all their licensure in place, they're well run, they're not profitable. And you just have these deposits dwindling, and it's cannibalizing itself. And so there's a lot of opportunity out there for guys like us to come in and attach ourselves to it, buy it. Now, just like Emmanuel said, we don't have that experience. You need to bring in that third or fourth person that, has done it and has run a bank at that level. But it gives us a tremendous amount more opportunity. And it gives them a tremendous amount more opportunity because they just don't know how to lend. They don't know how to get out of their own way. And they really don't know how to look past, the fire station at the end of the street for business.
You're also, don't forget too, when you're at that level, you're servicing your own loans, which means you're portfolioing your own product. So you can ultimately do anything you want, right? And now all of a sudden, now you actually take a look and it's just lending based on a certain amount of guidelines, but a certain amount of common sense as well. And you look at different things, and so you're able to do different deals and things that
You
might
can stretch the
make sense.
guidelines a little bit.
Absolutely.
It becomes a little more of a gray area than just a hard.
Well, you're going to have
black and
some
white.
paper that
Yeah.
you sell to Fannie and Freddie, and
Right.
that
That's
you
true.
sell to Ginnie, and then you're going to have some paper that you're going to decide to keep. You can create speaking of investors, you can create lots of non-QM products on your own and really go to market with that. You could have to the point that, look, here's what happened on with some of these banks that are failed. It's all about deposits, right? They lend off those deposits. And when people pull those deposits, it's a big issue. But it's really easy to get deposits if you also combine it with lending. So if you look at, I don't know what today's 30-year fix on a jumbo is, but let's just say it's 7%, 6.5%, 7%. If we had a jumbo product that was 5%, but I said, you got to put $1 million of cash in there, we'd be able to sell that very easily. Now you've got all of a sudden, imagine all those deposits you're bringing in. So it's just about being able to do different things that we currently, under our structure, we don't have access to do. So I think that's kind of the dream and the end goal, to try and get to something that would be fun to play with.
Very
Okay.
cool.
Yeah. I know the majority of your business right now is in Florida. That's where you started, and Florida's a big state. But how many states are you licensed in currently?
14 going on 15. So
Awesome.
we've got, California, Colorado, Texas, we're actually starting to do a lot of business in.
Right.
We've been doing a lot of recruiting of loan officers. I think we've got 3 or 4 and a couple of branches that we're actively talking to, and up and down the seacoast as well.
How different is that doing a loan here with your back office team located mostly here in Florida? How different is it doing a loan in Texas versus doing a loan here in South Florida? And maybe let me let Jared answer that, since he's the main operations guy.
We're spoiled here in Florida.
Yeah.
There's not a whole lot of called Florida overlays outside of condo lending. We're the condo capital of the world here in Boca
Right, of course.
Raton. Growing up in the business in the condo capital means we can really do that anywhere. So great advantage for us in the Houston market, in the Dallas market, and in any major city that, they don't do a lot of condos.
Mm-hmm.
Every state's a little different. Every state
Yeah.
has its unique challenges. It has its unique, it's just its unique feel. Every county, every city, they do business a little differently. Just to give you an example, in Florida, we are like clockwork with our tax bills. I mean, you guys are both property owners in Florida. You know when to expect it. You know when to expect the estimate. You know when to expect the trim. You know what website to log on to. You know how to pay it. I mean, you don't realize how great it is until you start doing business in certain states and certain counties, where when you give the county assessor a call, they go, well, it was supposed to come out on November 1st. We're really aiming for the 17th, but it could be any time in the 3 weeks.
Wow.
And here we are trying to close, business there, and we're supposed to pay a tax bill that we don't know what the amount is. That can affect your debt to income ratios. I mean, that's just kind of a microcosm of lending in these different places, especially more established cities and counties and municipalities that have been doing it this way forever. So, there's those localities that you got to figure out, but they've been figured out. We're not reinventing the wheel. You just have to get a little bit more familiar with it. And that's why it's important for, you to have people there. We're doing more business in Texas because we have more people from Texas in the company. We have more operational staff. We have more loan officers, which means that they know those intricacies as well.
Appraisals are definitely unique too. I remember doing a loan a few years ago in Maine, and that due to the demand, this was during COVID, and I think they were like 30 days. And I'm like, no. I'm like, that's not acceptable. They're like, oh, no, it's 30 days. I'm like, well, get the appraiser on the phone. Like, how much money does he want to get it done in a week? And they're like, well, what do you mean? I'm like, well, this is South Florida. Like, money will get you anything you want. So tell me how much you take, and it was like, we paid $2,000 for an appraisal, but we got it within a week. Yeah. Like, I'm not accepting 30 days. Come on.
Yeah.
That's ridiculous.
It is something I've noticed, that the technology in the local governments here is superior to many areas outside of South Florida. Even some places in Florida, a little difficult depending on the county, right?
It can be. The websites can be a little
Totally.
quirky. Because we practice in all 67 counties in Florida, both from a litigation perspective, but also from the title and closing perspective. So we're constantly going to the tax, assessor's office or the property appraiser's offices, and they're pretty darn good in Florida. But yeah, some of those little podunk counties can be a little quirky. But let's dive into sort of what we've been seeing here, maybe the last year and a half with rates. Today is November 28, 2023. What have you all been seeing the last year and a half? I think it's pretty obvious that rates have been going up as the Fed has been hiking them. What has that been doing to the market overall, and where are we at today? So maybe give us a little guidance.
Want to start and I'll go after?
Yeah, I mean, in the market today, overall, we're fortunate that the majority of our business is in Florida. It's a little bit of a haven here, as you guys know. We have not seen that major decrease that you see in some places in Middle America. It's tough to say where we, at least for me, where I think rates are going. All the indicators that you look at traditionally are on their heads.
Yeah.
That's why I wanted you to go first. We're going to give my prediction.
Yeah. Well, no,
I feel strong about my prediction.
That's why you're the crazy one, and I got to figure it out. No, it's tough. You see something that for the last decade, you see a piece of news that meant, great, it's going to be a great day in the market for rates, and all of a sudden you look at mortgage-backed securities market, which is the best arbiter of where rates are, and it's the complete opposite direction. And you can't figure out why. And, the four of us were laughing before about Barry Habib, who's a big name in the industry in terms of rates. And, he always has a way to shape why it happened after the fact. And that's always easy to look at hindsight. But before, you can't predict it. And this is a guy who's been doing it 40 years. So how am I supposed to predict it?
Yeah, I want to see someone with a crystal ball that works.
Yeah, right.
Yeah.
Now, with that said, one of these indicators that hopefully is going to go in this direction, European central banks have started to decrease rates. We had a few different Fed governors speak today. They said some things that weren't as positive as I would have hoped, but the mortgage-backed securities market reacted in a way that they thought it was positive enough. We're looking for a little bit more of a signal from Jerome Powell that he's done cutting rates, and I think that signal comes. And
done increasing rates.
Rates. I don't think he's not going to come out and just flat say like, "Hey, we're getting ready to cut them." That's not the tone he's been going with. It's not the message that he's been sending. But the last time he said something to the effect, the last time he spoke, that he saw kind of equal pressures on both sides. I don't remember his exact wording, and that was like the most positive I've seen him speak in 2 years. So long way of me saying I really think that Q1 here of 2024 is where we're going to start seeing that pressure decreasing. Maybe Q2 is where they actually start cutting rates at the central bank level. And by the end of the year, I'm cautiously optimistic we're going to see rates in the low to mid fives, but who knows? Those indicators could be completely wrong, and I could be, rubbing my crystal ball that doesn't work so well right now.
Well, anything could happen. We could go to war with Iran, or we could,
that might be good for rates. Who knows?
That could probably be really, really good for rates,
Yeah.
but not that we're asking for that. But yeah, so thank you. Yeah.
I actually saw a gentleman that was just talking on, I don't know his name, otherwise I'd give him credit, but then he was saying that there's going to be something cataclysmic within 90 days, whether it's the commercial markets that are starting to bear issues, whether it's war, something taking off. So I think one of the things that's really kind of important to digest and understand when looking at interest rates, and not to make it complicated, but to keep it fairly simple. Like Jared said, we typically look at the yield on the 10-year bond right? And I think it's at 4.35, 4.3, wherever it is today. And traditionally, a 30-year fix is typically 200 basis points higher. That means today's interest rates should be 6.4. They shouldn't be 7.25 or whatever it is.
Which is where they're really at.
Which is where they're really at. So my prediction.
So they're almost 300 basis points higher.
Yes.
Mm-hmm. Okay.
And so because of that, in that additional 100 basis points, by the way, is simply uncertainty. It's uncertainty. And if I would talk to Mr. Powell, I would say, just say something that you understand. You know, like they're so political where they're not willing to make a comment one way or another that unless it's in their best interest. But literally,
you could listen to them for 10 minutes, a 10-minute speech.
You have no clue what they meant.
And at the end, you're like, I heard them use big words in industry speak, and I know what the words mean, but I can't put it all together into just a simple, axiom or I don't know, just a conclusion.
That 100 basis points over margin, that to me is the reason why I'm more optimistic in the time span that things will happen than Jared and most people. I believe you're going to see before the end of the year, my predictions have been, you'll see an interest rate that starts with a 6 in 2023. And I think you'll see something that starts with a 5 before the end of Q2. And I think that for us here in South Florida, it's going to be, I think it was NAR had a stat, and I know you and I had talked about this before, Larry, that if they were saying anything that starts with a 5 in front of it, it's a buying spree. It's going to be a bonanza, and it's going to get crazy again.
If that happens here in South Florida, if we end up in the 5s, the market's already in like a very low inventory environment. It's going to be chaos again.
You're going to go back to 15 offers, on day one
again.
Yeah. It will, but in a weird way, what people aren't really thinking about, and I've heard a couple smart pundits talk about this from the real estate perspective, is that will actually open up supply as well. Because right now, our supply is so low. Why prices, at least in South Florida, are hanging tight. In other parts of the country, like Texas and some other states, they've seen huge price increases. And then in the last year and a half, we've seen major price decreases, is because they were building so many, such large amounts of housing and new homes and new construction. And then suddenly, obviously, the buyers went off a cliff. So the demand has gone off a cliff. And they have all this oversupply. So that caused prices to decrease. Here, we don't have very much building at all. We have no ability to increase supply. But people are not moving because they're trapped by their 3% and 3.5% and 4% rates. I can tell you I am. I mean, Leanne and I have looked around, not that we're really looking to move. Leanne is my wife. Hi, baby. But we've just looked around at other places, just for kind of kicks and giggles. But I would never go somewhere right now because we're in a 3.5% mortgage. What am I going to do? Go jump into a 7.5% mortgage and then pay more taxes? And I think a lot of people are making that analysis, and no better person to speak to this than Larry, because you're on the ground every day, right?
Absolutely. Here's an interesting example. I've just been spending a lot of time around a lot of the new construction here in Boca. And so the Lotus Palm community, 525 homes, maybe half built, pretty much with the exception of, I think, 10 homes completely sold out, pre-sold. People who bought homes in Lotus Palm are not going to be able to move into that home for at least a year.
Wow. Just share what the price point is.
And the price point is anywhere from 1.3, which is not really realistic, to 2 million-ish, 2.5, somewhere in that space. Mm-hmm. Yeah. And Lotus Palm, or Lotus GL Homes is the builder. GL is already building next door another Lotus community, or they're in the process. They're moving dirt, and they're getting ready to start pre-sales on that. And then if you look at any of I think the cheapest condo in downtown Boca that's new construction is in the 2s. I don't even think you can touch that right now, but they sold for somewhere in the 2s, and they run up to 27 million, right? And almost all of that's sold out in any of those buildings in downtown Boca. And there's a substantial amount of buildings that are completely pre-sold. The construction's not even done. Look at the Mandarin Oriental.
That's been pre-sold for 5 years.
It's been pre-sold for 5 years. I think they started working on that in 2015, 16 or something like that.
What do you think about affordability, Larry? Because, this is all great, but every one of those houses, when you're at 1.5, 2 million, that these tend to be a lot of self-employed individuals, entrepreneurs. They're high income earners in order to afford those types of homes. You still need service workers. We still need lots of individuals that are, where are they going to live?
Yeah, and that's why Jared and I have done so well in our investing here in South Florida, because we've bought arguably some of the lowest income buildings you can buy in South
We like
Florida.
to call it workforce housing, not being slumlords. We're workforce housing owners. Yeah, no, I'm joking.
And we take good care of our property.
We do. We
defend
take
ourselves
good care.
here.
Yeah.
But yeah, I mean the workforce housing product here in South Florida, you can't duplicate it with new construction because you wouldn't be able to sell it.
Too much.
It costs too much money, or rent it out. So anything that's new construction is being rented for huge numbers right now. And so our stuff is completely, while rents are pulling back in condo communities and other stuff like that, I would argue, while we might be feeling a little softening, I mean,
We're stable.
It's stable.
And we've seen a huge run up in rents in the last two and a half years, from 2.1s going from maybe 1,300 a month to now pushing 1,800. If you have even slightly more decent areas, maybe pushing 1,900, 2,000. So you've seen a 30 to 40% increase in rents just in 2 years, and that's stabilized. So that's not like that was some artificial.
It's stable
increase
right now. Yeah, it's stable. So,
but to your point though, Emmanuel, it is a concern. I think it's a concern nationally. You have young people, Gen Z, they talk about that. They're coming out of college, or maybe they've been out of college for 5 years. They're starting to get married. They're trying to settle down. Maybe they're about to have their first kids in the late 20s, early 30s. What are they going to do? Where do they live? I guess they have to live in their parents' basement for the next 5 years and save up money. It's affordability is a major problem in America. I mean, I think there's a lot of underlying reasons for that. We're not an macroeconomy, podcast going on here. We get into the debt, the $2 trillion in debt, and printing of money and inflation and all that good stuff. But back to the point at hand. So your prediction is that we're going to see some softening in rates, and we already have seen just the first beginnings of that. We were just before the podcast, you were telling me that rates have dropped almost 50 basis points, which would be, for the layman out there, 0.5%, close to that, which is great. Would you say that's the first softening that you've seen in the last year and a half? Is this more or less?
So it's kind of the second. So we hit a peak, maybe a month ago when rates basically hit 8%. They didn't stay above 8 very long.
Okay.
But you've had that quick little drop, and now that we're having another one, there's obviously a huge. It's just like anything. It's all about consumer confidence, and unfortunately, the media, when it goes out there and it talks about how high rates are and how everything is unaffordable, it takes a negative connotation, takes a negative spin, and then all of a sudden, people make the assumption that they can't afford to buy a home. And, we were talking off air prior that it's at the end of the day, we've got to focus on getting back to what the payment is, what the affordability is for an individual. An individual really has 3 choices: live with mom and dad. You can go rent something, right? And we all know rents around here aren't very cheap, right? We got guys like you guys spiking those rents up. No, just kidding. No, but we've got, rents aren't cheap at all. It's a fact, right? Or you can buy. And so we've got to figure out how to make it affordable for those individuals. And
you have some. Let's transition into some programs. What are these, like 3-1, 2-1 buy down programs? To give us a little bit of some programs that are out there right now.
I know you're looking at me, but you love the 3-2-1 buy. We were talking about it at lunch, and he was laughing because I was talking about it to someone. He's like, you're coming around on this. But Manuel's the master of the 3-2-1, so I'll let him take it.
The background.
So the temporary buy down product, here's what I love it for lots of different reasons. Yes, it's a marketing thing, right? Like most things, they're marketing things. And if you really want to have a detailed discussion, he can make an argument, or I can make an argument why it's good or it's bad, right? But at the end of the day, the bottom line is that to an end user, it's going to get you to a payment And the whole concept, for anyone who doesn't know what a temporary buy down is essentially you're getting the seller to subsidize your interest rate. So on a 3-2-1, if today's interest rate was 7.5%, it means that you're going to make a payment based on a 4.5% interest rate for your first year, 5.5% your second year, 6.5% your third year. Now, the reason that I love this product so much is that it's giving us affordability today while we know interest rates are high, while inflation is coming down and the rest of consumer goods. We also know we've got a major problem with consumer debt in terms of credit card debt, student debt. All these things are at an all-time high. So anything that we can do to give reprieve to a consumer, and in the form of having a lower interest rate that gives them a lower payment, and that makes things much more
a little breathing room for the first year or two,
affordable.
because there's moving costs. There's buying furniture when you're moving into a new place. There's all of those expenses that come with buying a new home. So for that first year or two where they're having significantly lower payments, that's giving them the breathing room to kind of get caught up on their payments, their credit card debt, et cetera, right? Is that
Of course. And the best feature about it too is, depending on who's right, whether Jared or myself are right in terms of when the rates come into the fives, the point will be that what I love is that unlike a permanent buy down, if you refinance 6 months after a permanent buy down, that money's gone. You're not getting any of that money back. Because this temporary buy down, the money sits in an escrow account. So it's a subsidy. That's all it is. They're just pulling from it every single month. So whatever portion of the subsidy you don't use gets deducted off the principal balance when you refinance. So the person doesn't lose. We could do a transaction with a 3-2-1 for the next 3 years, but rates 12 months from now are at 5.5%. Lock that bad boy in. Like, it's time to refinance. Do your 30-year fix back at 5.5.
Got it. Okay. So it's
and then you would still get those 2 years worth of funds that you didn't use would come right off that principal balance. That's why I like it, because you're not really ever losing.
That makes sense. And listen, if you ask, I've seen the charts from the Fed governors of their predictions of where rates will be, and every single one of them believe that, let's say 12, 24 months from now, rates will be significantly lower. So if you follow the experts that are voting on these policies, then that's a perfect vehicle to get you across that hump here where rates are high temporarily, and we're going to see them fall, right? Is that another way to explain that from a layman's perspective, maybe? I don't know.
Yes, agree.
Yeah.
Are you doing a lot of 3-2-1s right now?
So a 3-2-1, so again, the way that you have to calculate the amount that you're getting the seller to negotiate is based on that drop. So the larger the drop, the larger the loan amount. So, if we have a $700,000 purchase price and we need a 3-2-1, it's going to be almost $30,000, $32,000. So we've got to now factor in what are called the interested party contributions, which are the seller concessions, the percentages that you're allowed to give versus what you're not allowed to give. So it depends on what the buyer is putting down. I don't know that you see as much. Now, what I would tell you as a real estate agent is that before you reduce the list price of any of your listings, offer a temporary buy down. Show on MLS that you've got it approved with your seller right away. Don't wait, right? And I literally, I had a loan officer ask me this yesterday. He called me and said, "Oh, tell me about this listing, this temporary buy down listing strategy that you have." And it's like, he's like, "Well, it's a brand new listing. Why would I approach this agent and tell him to do that?" And that's my whole point. You, just like the agent, are being reactive and you're waiting till the house sits 30 or 60 days. But Larry, if you sold a house in 3 days for full asking price versus this other agent that waited 45, 60 days before he actually did, and he reduced from his price down, which one's getting the next listing is? Larry is. Because Larry was fortuitous enough at the beginning to make sure that he understood that the buyer cares about payment. So, and you don't even have to negotiate. I would say, Larry, just put the house at $700,000. As long as you know it's going to appraise, get one of those temporary buy down products approved. Of course, you send them to Choice Mortgage Group. But outside of that, but in all honesty, the buyer, you can literally tell a buyer and a buying agent, "Hey, listen, I've already negotiated for you. I'm giving you $15,000 to get a 2-1 buy down. We're not negotiating off this sales price." And I think it makes your job easier, and it makes the buying agent who doesn't have, Larry's been doing this a really long time. He's a master negotiator, but not everyone else is. So now all of a sudden you take all those buying agents who don't have the ability to negotiate. It's really easy for them to say, hey, they won't let us negotiate, but look what they gave you.
Give you some lower payments for a couple of years. Now,
You're
there's
giving
value
them,
in that.
You're giving them the script. I mean, I was having this discussion with my wife last night. She was asking me about home prices here in Boca. And she's like, where do you think the purchase price will be of our next home? And I go, none of that matters. We're financed buyers. We're not buying in cash. Mm-hmm. What do you mean purchase price doesn't matter? Who looks at purchase price? Mm-hmm. It's a made up number for your finance buyers. How much cash is out of pocket? What's your monthly payment? And do those two numbers work for you? And that's what I tell every single client. Figure out those two numbers. The rest of it falls into place. And so when you're taking that and you're taking that strategy and you're giving it to, an inexperienced buying agent, which Larry, you know better than anybody, how many inexperienced buying agents do we have? What percentage of it is? I mean, here in Florida, it's, move to Florida to get your real estate license, right? You're giving them that script. They're going to do the negotiating for you with their client.
There's, I've heard this quote, and I'm going to butcher it, but an investor says, I'll let you choose the price, Mr. Seller. You let me choose the terms, right? And this is kind of in line with the same thing. It's like, who cares about the price as long as the terms work, right? The financing terms or whatever on the deal, as long as that works, right?
Yeah.
Yeah.
Look at some of the biggest business dealings that happen anywhere in the world. I mean, it's a little callous of me to say, because I'm definitely not doing these, but what's $1 billion here and there when you're talking about these mega corporations buying each other? It's nothing, because it's all about the terms. It's all about how are you financing it? Who's bringing the money to the table? When is that money due? There's so many moving parts. And even in a standard real estate contract, Florida, we're very fortunate. The FAR bar, our real estate contract, is really well balanced. It's really well written, better than a lot of those other states we do business in, I think. So,
Sure.
Yet another wrinkle there. But there's so many little pieces in there that are part of that negotiation that are just as, and if not more important than a reduction or an increase in price. And all those things get left by the wayside, including the financing for a lot of people, because they're so focused on that sticker price. That's what the internet age, that's what Zillow and Realtor.com has done to us. That big, pop up, here's the price I need to be looking at, here's the price I want to buy, price. No. Feature, benefit, impact, payment, cash out of pocket, affordability. That's really what they need to be looking at.
Yeah, unfortunately, that's the conditioning. It's hard to advertise really, really effectively the payment. It's right, because people are sorting listings by the price, right? They're getting prompted to open up their email because this fits into their criteria. Send me only listings 700 and below, when maybe a $750,000 listing would work from a payment perspective if it was structured properly.
But so, and I love that. And I think that's a perfect opportunity to talk about exactly why, as a listing agent, you can control the narrative by giving the payment, by pre-negotiating with your seller a temporary buy down, by working with your preferred lender. You can already have a system set up where you're advertising, and obviously you want the double dip. There's no reason that through your social media powers that you're not able to attract buyers simply by putting a payment out there. And the other reason that I mentioned about the lack of negotiation, it's we all want to hit the easy button, right? Sure. We've built our mortgage company around the concept that we want to make it as simple as possible, because we know they're not coming to us because they like us. As fun as we are, right? At the end of the day, the bottom line is that they're only with us because they need us. And everybody would hit the easy button if they could get a loan in 1, 2, 3. And so it's our job in all three of the facets of a transaction to literally make it as simple as possible for the consumer. So if you can take away that negotiation, if you can take away that back and forth, I've got to get a response within your offer in 24 hours. And then, again, it works in this market. And like any strategy, you adapt depending on the market. This particular market, this strategy works because you're not attracting as many buyers. When the rates go to the 5s, I would not tell you to do this strategy because you're going to have 20 offers on your houses. Now it's the other way around. How much overlist are you willing to offer? How much cash are you putting down? I want to wait, and this is what we had during COVID. You had to waive every inspection period. You had to find it, there was no appraisal contingencies. It was very different.
Yeah. Yeah. Speed was crucially important then during those times when you had 10 or 15 offers on a property in a matter of hours from when it became listed. So let's transition just a little bit into investor programs that you have. So you all obviously do loans, or a good portion of your loans are for conventional homeowners, people moving into their properties, whether they're first-time home buyers or whether they're just primary homeowners moving from house to house. But then you have another aspect of your business, which is doing loans for folks who have investor properties that are 4 units and under. So here in Florida, commercial is 5 units and above. You guys stay in your lane, which is the quote-unquote residential lane, 4 units and under. Larry and I have talked about this, ad nauseum. That one of the couple of the biggest challenges that investors have, like ourselves, and why we're very limited and handcuffed in our buying now, is that insurance has gone crazy. Prices on insurance have gone nuts here in Florida. I think a number of other states it has as well, up and down the East Coast, especially, anywhere in Hurricane Alley, gotten extremely expensive. And then, of course, property taxes have increased significantly, just due to prices overall in the market here in South Florida, especially. So those are 2 big challenges that are kind of keeping people somewhat out of the market. And then, of course, the third factor, the obvious one we've been talking about, is rates being high. Are there any? I'm just want to kind of open the door to that. Any thoughts you have for investors on, maybe some programs that are out there, or just ways that you've been helping investors to get into properties, programs you have, whatever it may be, whether they be foreign investors or domestic, people living in here. I'll put that out there.
Go ahead, Jared, but we can do up to 8 units, by the way.
Oh, you can? Okay.
Yeah.
I'd be interested to hear
I didn't know
a little
that.
bit about that.
So the DSCR loans, we can do 5 to 8 on a few of our investors. But
Okay.
Jared
good to know.
is our product specialist, so this is your.
The main product that's been out there the last few years for investors is the DSCR loan.
Okay.
It has to do with the cash flow of the property in the most basic sense. If the property produces $1 of rent, then you can have $1 of payment associated with it. $2 of rent, $2 of payment. That's principal, interest, taxes, insurances, HOA dues, any fees associated with the property. So long as it's covering it, and that's what DSCR stands for, debt service coverage ratio, you can get a loan. Now, within that spectrum, there are a ton of different products, and your most basic product is that 1-to-1 ratio. It is technically a business purpose loan. It's not a residential mortgage in that sense. And because it's a business purpose loan, it's treated a little bit differently. There are prepayment penalties associated with it. The rates are calculated a little bit differently, but it's a fantastic product for investors, especially when you have people who are buying, lots of properties. Because listen, if you have a good accountant and you have lots of properties, you're not looking very good on those tax returns, which is what us lenders like to see in the traditional sense. But while that's the traditional DSCR now, where you have that prepayment penalty, you have those higher rates, there are other types of products that we've started to specialize in within that DSCR space. So namely DSCRs for Airbnb income. It's a huge one down here. You see a property that maybe the rent schedule shows, just making up numbers here, $3,000 a month when you rent it out for 12 months. But down here in South Florida, certain weekends can get $3,000 a month on that property. And that Airbnb is really closer to $8,000 or $9,000 a month. So we have products for that. And then most importantly, and the one that we really focus on the most, especially in this declining interest rate environment now, whether you believe Emmanuel's timeline or mine or somebody else's, we're coming down in that 12 to 24 months. Well, everybody else is out here doing your traditional business purpose DSCR with a 5-year prepayment penalty on it. Well, that's 5% the first year, 4%, 3, 2, 1, all the way down. If rates come down in the first 12 months and you're starting at 8.5% today, that's a good, nice round number for someone with good credit and 20% down on this DSCR loan. And next year they're at 6.5%. Well, you want a cash flow. You guys are investors. You want to increase that cash flow, but you're going to pay a 5% prepayment penalty to make that happen. That doesn't look great. And so we have another DSCR product that isn't a business purpose loan, that doesn't have that prepayment penalty associated with it. And we've really been pushing our investor clientele there because the rates are comparable. it's a little bit more difficult to qualify for. It's a little bit more of an underwrite. I mean, we do it all the time, so it's just as smooth as any other DSCR. But when you're there, you know that, hey, even though I'm starting at 8.5 today, if they come down to 6.5, I'm not going to have that 5% I need to worry
So
about.
12 months, you can refi out of it. You can get into 6.75% loan or whatever it is at the time.
Absolutely. And while it comes in your standard 30-year 6, it has 32 flavors as well, or 31 flavors, whatever Baskin Robbins is. And we can do a 5-6 arm on it, which a lot of people know traditionally, but there's also 5-5 arms where it adjusts every 5 years. So you don't have that first payment adjustment for 5 years and then another 5 years after that to get a little bit of an interest rate bump. And then for our more adventurous, really more experienced investors, we can go all the way down to a 6-month arm. So the first interest rate adjustment is on month 7, but that rate is significantly more aggressive. So depending on what you're doing, we'll see a lot of people who are buying that next investment property. They're still planning on selling something and then paying down that loan, maybe in a 7 to 12 month time frame. That's a great product for them. So all of these kind of allow you to get in at a lower rate than a lot of these traditional investor products, but it also allows you that flexibility to refinance in a really short period of time.
The other cool thing with that product is that we're not limited with our states. I don't know if there's any state we can't do.
There's a couple, but
like 48 states
rare,
we can essentially lend. So because it's a business purpose loan, when we do it in that manner, we can literally do a loan anywhere, even though we as a company might not be licensed or as individuals may not be.
So there's no prohibition on you doing business for the DSCR loans.
We can do a loan in Washington. I'm not licensed in Washington, but if it's a DSCR business purpose loan, we can do that.
You're just brokering it out.
We are still working on our 15th state that Emmanuel mentioned earlier is Massachusetts.
Okay.
That should be coming shortly. And I believe it's tomorrow morning or right now, we are closing a DSCR loan in Massachusetts.
That's awesome.
Yeah.
Get all your Bostonian snowbirds here.
How do you get these? How do you get these licenses? You sit for the exams?
So the twofold. So as owners, one of us has to be the guarantor for the state, and then so the company has to get licensed, and each individual loan officer that wants to do loans in that state would have to get licensed as well. So it's not really that difficult. It's a little bit of continuing education. Each state is different. Some of them have E&O policies you got to do. Some of them have bonds that we got to do. Some different things, application fees. It's a money grab more than anything else.
As you can imagine, none of the states talk to each other, and none of them want to standardize anything at all.
Yeah. So there's almost no reciprocity between states.
Oh, there's no reciprocity.
And you can imagine certain states are more difficult. New York is almost impossible to do business in. Massachusetts, that we're just going in now, is also not an easy state, but we've got some branches up there that we're looking to recruit. So
it's worth it for you to do.
For us, yes.
Yeah. And you already have a bit of a presence up there in the Northeast because I know you're from there, from that New Hampshire area, Maine area. And
we're licensed in Maine and New Hampshire and Connecticut, New Jersey. And so
Massachusetts is a natural fit. Yeah. That makes sense. That's good. Larry, what have you seen? Because you do a ton of business, a lot of deals. What have been the challenges that you've had with loan officers, other loan officers, of course, not Emmanuel and Jared and Choice Mortgage, but
never.
I know from a title company perspective, I do title, our title department. We do a lot of deals, especially dealing with some of the brick and mortars that I call them, the Bank of Americas, the Wells Fargo. They're atrocious. Sorry, anyone that works for them, but your back end departments are terrible, and they blow through deadlines and closing dates and financing contingencies, and it's really, really nightmarish when I see that come across my desk. That someone's using one of those big, what I call brick and mortar banks, but even other loan shops that are out there, they're not all made equal. What are some of the common challenges that you see, out there where that Jared and Emmanuel can talk to how they do things differently?
I think the biggest thing from a execution perspective on the lending side, from my perspective as a real estate broker, is anticipating or preparing the buyer in advance and communicating clearly in advance. So like getting ahead of any of the unforeseen issues or the potential issues that could come up, right? We talked about some earlier, like for the condos, as we talked about, there's a lot of condos in here in South Florida, do a lot of condo deals, represent a lot of sellers that are doing these condo deals. And again, usually when I'm representing the buyer, we're already ahead of it. So we don't have these issues, but on the listing side, it's really hard sometimes to get with the lender to confirm that they can even write the loan or do the loan for a specific condo building for a number of reasons that we can get into. And so that's a big thing that I end up dealing with. And Emmanuel and the Choice team has a good solution on how to kind of dodge that if you're a listing agent, which I think is great. You and I were just talking about that. You could dive into that here in a minute. And then also, like, I don't know, Wells Fargo and these other big banks. I think the biggest hurdle with them is the lack of clarity and communication just upfront and throughout the process to really understand, can you actually hit the targets that we've written in this contract, right? And are they anticipating unforeseen issues with the borrower? And are they actually underwriting the borrower in full upfront, right? I think that's another big one. I mean, that's a big one. And it's sometimes hard to know that answer as a listing agent. And I'm a licensed mortgage broker, and I can somewhat talk the talk, and I get on the phone with these mortgage brokers, lenders, whomever that are representing the buyer when I'm representing the listing agent or the listing. And I can't always get the clarity that I'd like from that, even when I get them on the phone, if they pick up the phone. We'll start there, right? So yeah, maybe you can shed some light on just like the condo experience a little bit from your perspective and how you can help borrowers, buyers agents, and listing agents.
Yeah, so a couple things there. So to one of your points about, we had made a business decision a long time ago, which at the time was, felt revolutionary. It felt like the world was ending when we had decided to stop pulling credit on buyers until they send us all their documents. So our process and our policy is really simple. We take a loan application with an individual, and they've got to send us all their documents. And the reason, it's to your point, Larry, is that I'll never put a pre-approval out there with my name on it that's not going to close, right? There are unforeseen things that can happen, but it's not going to be because it was a lack of us verifying income, assets, or credit. We're doing all of that stuff up front. So number one, and that's part of the expectations. Part of our initial buyer consultation call is I'm having that conversation with you, Jerron, the buyer, saying, hey, here's what's going to happen. Yes, I'm going to ask you to do a little bit more work than the Wells Fargo guy who's having you do an online application, pulling your credit, and then saying, go shopping. So for us, we want to take it to another level. And I'll tell you, it's a little bit more work, but I'm going to personally get on the phone and call Larry, the listing agent, and let Larry know how much work we've done and how far we are, so that I can make sure that Larry can assure his client that, hey, this offer is much more solid than this other offer. One, it's a local company. There's accountability and locality, right? We're going to see each other all the time. And then number two, it's because we've done all of that work up front. So for me, that has been a huge decision. We made that decision a long time ago, and it's worked very, very well for us. Mm-hmm. With respect to the condos, Jared knows this stuff inside and out. But what I was telling Larry was essentially, we created a condo desk. And what we wanted, and we saw an opportunity because we realized so many condos were falling apart. And what would be a dead deal for, hey, this thing's falling apart. Can you save it? And we'd look at it and we're like, how did they mess this up? Or I'd look at it and say, they're telling you the condo denied it. This person doesn't income. It doesn't even come close to qualifying. So my issue that I have with our industry is that, or salespeople in general, will tell you what you want to hear when they need you, and then they have no problem telling you something completely different when they're denying a loan because of the condo when it was actually their income never qualified or something like that. So for the condo part, what we've decided to do is let's focus on this, because also from an affordability standpoint right now, like what we were talking about, some of the lower end price stuff is going to be condos. So we had to get really great. So why don't you tell them a little bit about the condo desk and how it works for us?
Yeah, I mean, you were mentioning it, Larry. A condo can be denied for a number of reasons. So every time I'm talking to a real estate agent or a borrower, and we start going down that condo path, I always try and take them on a little bit of a history lesson. I go, I'm sure you've heard of the Surfside building collapse, which happened, I think it's about 2.5 years ago now. And as an industry, we swung very, very hard to a direction where we needed to overly anticipate issues. And by overly anticipate, we're supposed to go as far as reading meeting minutes from the last 6 months of board meetings and determining from those meeting minutes if any upcoming assessments are going to happen. Now, sure, everybody here has sat on a condo board one time or another, other than me probably, because I try to avoid them like the plague. But I do go to my annual board meeting and live in the townhouse community, and I don't pay attention. And so who knows what's going on in those things, and who knows what's going on in the meeting minutes. I don't even think we take meeting minutes.
That's what I was going to say too.
Yeah.
I can't tell you it's our protocol to get a year's worth of meeting minutes, which is unrealistic to start with, right? But we do it on every listing, and we go ask the condo board for these things, and they look at us like we're out of our mind. I mean, we get a list, and it's on the addendum for buyers that says they have a 3-day right of rescission if you don't provide them X, Y, and Z, and meeting minutes is right on there. And I don't like half these condo buildings, they won't provide them to you. They don't have them. They don't know what they're doing. They lost them, right? Whatever. They're in writing. They're written down.
But that is the greatest challenge. The greatest challenge of a condo is not the actual determining whether or not this should be something that we should lend on. The greatest challenge is actually collecting and gathering the data and the information from the associations, the management companies. That's where it is. The whole purpose behind the condo desk is that, for me, I want somebody who will call 3 times a day and email. And the only way to have that is to have an actual dedicated employee whose sole job is to do that. So that's why we built that out. It wasn't about the reading of the different instruments. It's literally the grunt work.
Getting it.
Persistence.
Get that persistence.
Yeah, because of
Not giving up.
incompetence.
Yes.
You have that persistence because of their incompetence.
Well, the
Exactly.
property manager, in their mind, is not there to help us. Now, meanwhile, condo questionnaire fees, which our clients have to pay, have gotten astronomical. I mean, I've seen them high as $1,000 for them to answer some standard questions and give us these documents, which, the seller should be able to get for free. They're part of the board. But, person who mans our condo desk, Nico, he'll say to me, hey, this guy told me to stop emailing him and to stop following up. I'm like, that's a badge of honor, man. That's what we want to see.
Yeah.
Because to Emmanuel's point, that's the hardest part of this. Making a credit decision when you have everything in front of you rarely takes longer than an hour. I mean, it's just not the hard part of our business. It's getting the information needed for it. And so that's what our condo desk does. But to what we look at in a condo as lenders now, I mean, we're looking at the meeting minutes. We're looking at the budget, where in years past, if you were putting a big enough amount down, you didn't need to look at their financials. You need to look at everything the condo can provide and a lot of things they can't provide. You have to go on a fact-finding mission to try and make this determination, this very vague determination as to whether there's financial, structural stability and habitability, or there aren't issues in those places. You need to make sure they're properly insured, which
That's best you can bring up.
in Florida is a nightmare right now. In order to,
We've had a building recently that was not insured properly, and
The Edge?
it wasn't the Edge.
Oh.
It might have been. I don't know which one it was. And it wasn't insured properly. And we've been working with them for 30 days to get them to get insured properly so they can get financing. So this buyer can get financing, because they started to realize no one can get financing in this community. And the president, fortunately, was like worried about this and cared. So
it makes no
lucky.
sense.
Yeah.
It literally makes no sense. And for me, this should be protocol. This should be really something that's really simple. The issue with, and on one hand, I sit on my board for my association in my residence, and I understand that we make decisions oftentimes that you think are in the best interest of your clients, consumers, whoever you're representing, homeowners in this case. And because insurance, my community alone, insurance more than doubled in a year. Went from $125,000 to $280,000, something like that, right? And so because it's gotten so expensive, people are cutting corners and they're taking shortcuts. And so, for example, the reason I thought it was the Edge, because I just had a transaction where a realtor called me up and said, hey, can you save this? And I said, well, why is it dying? And well, they increased their hurricane deductible to 10%. I said, well, no, that's not allowed. I can't, they can't do that. Oh, well, they did that because, the premium was going to go too high or whatever it is. So sometimes they're making financial decisions, but meanwhile, if I'm a homeowner and I realize that you didn't increase my dues by $100 a month because you didn't want to pay the increase in insurance, but you just negated my ability to sell, to 60%, 70% of the potential buyers, because now we can't finance that property. You know,
Well, now the value of your property
and the value just
dropped.
went down.
Yeah,
And
maybe 10, 20%.
Exactly.
Yeah.
So
Yeah.
it
crazy.
some of it is just people just don't think.
It's illogical.
Nobody's explaining it to them. You know, obviously the insurance agents aren't. The easiest thing going back to purchase price of a property is the only thing you're looking at on that insurance policy is that price, right? And I've talked to enough building, not necessarily the property manager, they usually know what's going on, but the HOA president, you say, hey, you guys changed insurance. Oh yeah, we needed to do this for, what they thought was a smart financial decision. I go, your building is not properly insured. If you look at your appraisal, it's at 50 million. These big buildings cost a lot of money. You're insured for 30 million. What does that mean? That means you guys need to cough up 20 million if a hurricane comes and knocks this building out. And they're floored every time. Oh, and by the way, until then, your property values suck because nobody can buy it. You're in a price point that's going to demand probably higher than 60 or 70% financing buyers. It's probably 90 to 100% financing buyers in these price points, especially in South Florida. And they just don't get it. And, it's a sad thing that we see really often, especially when we get called to save these deals. They shouldn't have been deals to begin with, which is another kind of aspect to the condo desk and aspect to, our process here is we try and gather as much information up front as possible. We have a quick 7-question questionnaire that we try and pass on to listing agents. Most of them aren't as proactive as you, and they won't know the answers to these. But a lot of these questions can be found out or a lot of these answers rather can be just be found out by asking really open-ended questions like, hey, have your dues gone up? Has there been any insurance talk? Have you seen repair crews around there? Do your balconies work? Just things that you as an informed agent, as an informed buyer should be asking. And we encourage that. We encourage our loan officers to talk to their agents about it. We encourage our buyers to talk about it prior to putting in an offer. And you can find out a lot upfront by just asking those general human questions.
I thought of a business idea. We should create a consulting company that allows all these HOAs to consult us during their budget process.
Oh, yeah, they're going to pay more. That's what they want.
Yeah.
Another cost.
Hey,
if it's free,
but it's not. I mean, if you can't finance your properties because of it, but yeah, it's just a lack of knowledge.
That is crazy. Yeah, but Larry, do you have other questions of Emmanuel and Jared?
Where do you guys? You kind of mentioned, you kind of alluded to where you wanted to take the business. What's the next step for you guys here?
Well, in the immediate run, obviously it's to stay alive. I mean, it's not like the business is in general that, the entire industry, most mortgage companies are not making money. Most mortgage companies are floating by. Luckily, we made our hard decisions, I don't know, I guess it was at some point last year. And when we cut some of our workforce down. But that part of it is my job, and part of it is my job is to go out there and to find unique venues. We've partnered with some builders since last year. I've got a new listing agent concept that I'm, we're working with, and we're trying to go out there and find different revenue sources and find different avenues to do business. We're expanding our cup size, so to speak, and that's why we're heavily recruiting. And we didn't even start recruiting until March, and so that's going really well for us. And so we're excited to expand upon all of that. At the end of the day, we can't control where rates are, and it's going to be the rates are the same for everybody else. So you just got to roll your sleeves up and go to work. And we've got to work twice as hard to make less money than we did in the past, but that's okay. We're going to be there. And there's a stat. I think the numbers are within a 1 year period, or from 2021, there was about 171,000 loan officers nationally. And they say by the end of this year, we should be around 70,000. So there's been that much of a decline in loan officers.
60% attrition, more or less.
Which sounds doom and gloom, but no. Like, what an amazing opportunity. There's so many people that are going to be exiting the business. So we came up with a concept called low annuity, which is essentially I like retiring loan officers. Basically what we do is they hang their license with us. They don't have to do any of the work. We pay them for their database. Let their database work. We'll work the database, partner them with one of our loan officers. So that's a cool, unique strategy in order to let people retire but make money. And because that was obviously, there's a need. So it's just about getting creative, finding different things that we can do that will generate revenue for us.
It's great.
That's interesting. So obviously refis are basically gone, right? You're not doing refis. And was that a big bulk of the business before or no?
So for us, I don't, Jared can answer our specific numbers. For me, I'd say I was probably a 60-40 purchase refi. So I did do quite a bit. We market to our database quite a bit. So we've got a really high repeat and refinance business. And you'd be surprised, refinances aren't all gone. They're starting to come back. Student loans just came, people started having to pay them in October. Credit card debt is in 25% interest rates. The cost of living, and as the reason things are about to shift is that although we have been in a recession for quite some time, the rest of the economy is starting to catch up on that recession. And as that happens, people get a little bit desperate, but they still have a tremendous amount of equity in their homes. So people are going to be forced to tap into that equity in order to pay these bills, to pay off this debt. I take loan applications. Somebody has $50,000, $60,000 in credit card debt. Like, who cares if your rate is 3%? Like, my 7% will still, consolidating all of this debt will still save you $2,000 of minimum payments. Compared to 25%, you kidding? And plus, we're amortizing this over 30 years. So, you can still save a lot of money. So refinances are right around the corner from really picking up.
That's interesting. What I've seen too from a recruiting perspective is, and as you mentioned, like the real estate brokers, the mortgage brokers, they've kind of felt the pullback, right? Real estate agents as well, right? There's more agents that jumped in the business 2020, 2021, and 2022 that were doing well. And if you look at their stats, they sold 6 million, 4 million, right? Last year. And this year, they're like not even anywhere near that. Because they did like 3 deals last year. And fortunately in South Florida, you can pick up 4 deals and hit 6 million pretty easily if you're lucky, right? If you're fortunate. So from a recruiting perspective, there's more people that are willing to think about or consider changing. Before they thought they knew it all. Like they were like, 6 million, dude, I just did 10 million, Larry. Why would I consider like joining the team? I don't need education. I don't need support. I did 10 million. And now they're not doing 10 million or anywhere near it.
And it's also too, this time for us, things have slowed down as well on the transactional side because we're all, on that side that we're all doing transactional business. But one of the great things is, I believe that you all shared in this same issue is staffing. A year and a half, 2 years, 3 years ago when things were, just absolutely bonkers, bananas, finding good people who are competent and experienced to give great, exceptional client service and customer service who had a number of years experience in the industry was near impossible. And you're having to pay exorbitant amounts. And the same set of, 20, 30 loan shops are probably looking for the same handful of loan partners or processors or closers. And on our end, we have closers too. That we had one open closer position that we were trying to fill for at least a year and a half. And we had to rotate in a few different people that just didn't really work out. Only now, since things have slowed down, we're able to recently fill that with a great, brand new, woman. Has 20 plus years experience. She's fantastic, great attitude. And that's only happened because of this changing economy and because her business was downsizing the title company she was working for. So I don't know if you've noticed that, but less attrition, less the team, the back office team, our back office team is working much better, smoother, and you're able to get people trained up on those things that you didn't have the time to do before. So it's kind of two sides to a coin. Yes, business is down, but now you can work on your business instead of always being behind the 8 ball. That's been my experience on the transactional side of things. I don't know if you share in that. But,
oh, for sure.
Yeah.
I mean, we've been able to keep the best of the best.
Mm-hmm.
I even though we're not hiring currently, I still go and take a few applications and interviews every couple months just to see what the market is, to keep my finger on the pulse. And you have 30-year experienced quality control managers, underwriting managers interviewing for entry-level positions right now, just to give you an idea of the state of the industry, because we really beefed up over the last few years. And, sadly, these larger corporations cut the top because it was where you were able to save the most money and kept the bottom. So, everybody we have here is not only the best of the best, but has the best of the best attitude. And so we notice on those days that we're a little bit busier that they give that little bit more really easily. You don't have that non-cohesive team chemistry that you had to have just to survive in 2020 and 2021. We were hiring people off the streets. We created positions. We were making up names of these positions because essentially we needed someone to take a piece of paper from here to here.
You need butts in the seats.
We needed butts in the seats, and we needed somebody to look at a piece of information over and over, do a repetitive task over and over. We hired a lot of people right out of college, and we got some great talent out of that stuck with us, and we were able to train up and pull through the system. Good. And we got some not so great talent from it. I mean, that's just what happens.
Yeah.
But on top of that, now that we have the best of the best and the people that care the most of the most, they're able to do those jobs so efficiently without us micromanaging them, and that gives us time to put in systems, to put in automation, to put in new technologies, to try new things, to bring in new products. Those DSCR products I was telling you about, it's like a new aggregator or investor for us, comes out with them a new one every week. And when you don't have these kind of people in place, it takes a long time to implement. You have to really, go through everything, update your technology. And for us, I get an email from Emmanuel, says, hey, we got to get this thing moving. Here's, I did the paperwork, as he says, and let's, we're going to get one in the pipeline. And I got my team, and it's barely a meeting with us at this point going, we have a new product, everybody read up on it, quick meeting, and we're good to go. And that's the great piece of this, is that we're able to so smoothly do new things.
To Larry's point too, that he was talking about recruiting, that's actually our strongest suit is our support staff. So one of the things that happens as mortgage companies, when times get a little bit tougher, the first thing that goes is operational people, and that's support. So the fat cat loan officers that are used to having all this assistance no longer have it. And all of a sudden it becomes a much tougher for them to survive, and for them they've got to start doing a lot of that. So that's what we tend to push on for our particular, recruiter. And as he's out there promoting our brand is, we have a whole system where we want loan officers to do very little so that our operational team can control what that client experience and that referral partner experience looks like.
That's great. Operations and back end is super important. I focus on that as well. We bond over that for sure. I see right now as an opportunity to double down on just marketing, systems, all that stuff, right? I'm not pulling off the gas pedal here at all.
Have you gotten into any AI stuff?
We've looked at a bunch of stuff. I just don't love. So we use some AI stuff for content creation. It's an aid, not so much plug it in, it spits out the final product, but it's an aid to my team on how we're all creating specific content on our digital channels. So that's huge. I mean, that's been a game changer. But as far as, they're coming out with all these different AI things where they can mimic your conversation. You can send out a ton of videos, but it's not right. Everything I've looked at isn't right. And then the stuff that is, they've even, I looked at this maybe a week ago. Somebody sent it to me. There's an AI that will literally have a conversation. It'll answer the phone when it rings and have a conversation with you. And I demoed it a little bit. Still not perfect. I just can't get there. Even with the text message AI options, I can't even get there. My team can answer these questions and work through it. So that's where I'm at with the AI. Maybe AI, there's so many people that swear by this right now or pitch it. We'll put it this way. Brokerages. Sir Hunt's a great example of that. They pitch it pretty hard. There's others that pitch it pretty hard. It's not perfect.
The content creation, we're revamping our website. And I think we were just before the podcast, I think you are as well. And we're doing some real geographically targeted web pages for our landlord tenant side of the business for certain cities and counties here in Florida. And it's a lot of repetitive work. And so we're utilizing Bing and ChatGPT, and we're kind of bouncing between the two to create a lot of that, to recreate a lot of that content, and then going back with a human touch and obviously tweaking that, massaging it a bit. But there's uses for it, I believe. But like Larry said, at least from my opinion, none of it comes out pristine. You need to kind of massage it a little bit from what I've seen.
I have my concerns about that too, just from like taking ChatGPT stuff, tweaking it a little bit, and putting it up. I think there's been stuff I've read that suggests that the Googles of the world, et cetera, that are crawling the internet, they can sometimes recognize.
Okay. Well, the AI verbiage, you can look at certain words that ChatGPT uses all the time that we wouldn't use. We've started, there's a couple different things that we've tried to use it from marketing standpoint. It's good in content creation, but it requires editing for sure. You've got to go back in and use the verbiage that this is how I speak. I want it to sound like me if it's going to be like that. One of the things that I just saw a presentation on this new CRM that is essentially, we've got our operating CRM, which is what sends out all the emails, the touch points, things for loans. But this is a new CRM that's going to be kind of more sales related, and it's much more AI function to kind of work your database for you and all these different things. So I'm like you, 95% is not good enough for me, not on this type of product. Once it gets to be 99 or 100, I'll buy in. I've got my eye on it. I'm watching it. I'm certainly no techie, but I understand the human experience. And as long as, again, it's really easy to make decisions for me because I think just like you do, I just call it the client experience. I need that client experience to look and feel a certain way. And if AI is not going to deliver it in the way that I want it to, I'm not ready to adopt.
You can blow up your credibility from
Exactly.
one stupid text message from an AI or even an assistant. Like I have that problem with some of my assistants. Like I tell them, like, if they're texting from my line, like, you represent me, so make sure it's right, and occasionally that gets messed up. Right. Jerron's probably experienced it.
But that's it. But
he's
a big
genius
part,
because people expect Larry to handle all his business, and he does such a large volume of business and has so many transactions going on that he's got support behind him that do have access to his emails and his text messages so that they can help support him when he's busy in meetings or listing appointments. So sometimes the messages are coming from Larry and sometimes it's from his staff. In fact, you just got me under contract for a flip that we've done, a foreclosure flip that you identified and sourced for my business partner, Chris, and I. We flipped it. You just got us a fantastic offer on it, which we're under contract for. So I'm experiencing your transaction process as it's going along, and it's really buttoned up. So whatever you've done so far to get it to that point is great. I haven't gotten any really bad texts. So
what it is, it's about scalability, and you've built a business. It doesn't have to be real estate related. It could be any business. The idea is understanding how to build a platform, how to build something that is scalable. As an entrepreneur, it doesn't matter what you do. You can't be everywhere at once. You can't be a buying agent for him, a listing agent for me, a mortgage broker, a title. You can't be everything all at one time. And so we need to use our support team. And there's some old school loan officers who feel like they need to hug this file, and they still call it a file because they're using paper, and that's just not how it works today. And I think that from a client perspective, we train our people. We use the word sweat, which is same way every time, but we train our people specifically to say certain things. So you will get updates. For us, our processors reach out every single Friday. They reach out to the buyer, they make a phone call to the buyer, and then they write to the buying agent. They want to let you know going into the weekend, we don't want you to worry about what's happening. Here's what's going on. Here's the update. And by the way, we're in process for a smooth and flawless closing. We use that track that track talk, because we know it's something that you want to hear. People just want to know that you're closing on time. They want great communication, close on time.
Mm-hmm. Yep. But while still having access to you, the loan officer, or the listing agent, their agent, when they need it. I believe, so I'm the attorney on our transactions, but I've got 5 closers and 3 or 4 processors that work on the team. They know that they're not speaking to me all the time, but they also know that if a fire's about to break out or there's a problem, they can get in touch with me. They'll have my cell phone number, whatever it is, and I'll help put that fire out. And I think people know that, and they're okay with that in a service-based business. They don't expect that every email or every text is going to come directly from you and it has to be you. I think that's how the modern consumer works, and they're okay with that as long as you are there when they need you.
Well, and I think as long as somebody's there and it's not you, and I think that's where, to your point, Larry, like that uncanny valley, like you see in a movie where they use CGI and it's not a real person, you can just instantly tell with their eyes. That to me is where AI is. I hate the term AI. It's such a hot term right now. They're slapping AI on everything, and like Emmanuel and I'll get into this. What about AI for this? It's not AI. It's large language models. They're just predicting words, and it's great for content creation. It's great for an idea. It's great for a framework. But yeah, in a service-based industry, there needs to be someone there, even if it's not you. And if it gets to that point where it needs to be you, it does need to be you. It can't be AI, Jerron. It would be really cool if I was back in my office right now doing some other project while AI Jared was sitting here doing this podcast. But you wouldn't have all this charm.
But you know what though? To add to that, just my only advice that I would suggest in saying that is, it's all about who the audience is. I think your referral partner, they want to get a hold of you if they need you. The client doesn't ever need you or me. They need, to Jared's point, they need an answer. They need a live human being you have a problem right now, Larry, let me jump on that. Let me move you to the front of the list, whatever you want to use.
95% of the time I'm dealing with the realtor. It's only the 5% of the time do I deal with the actual buyer or seller on my closing file. So right. Yeah, I agree with you.
Because
my client,
look at Rocket Mortgage,
yeah.
Right? They're gigantic. Who's at the other end of Rocket Mortgage? You have no clue. It's a calling center, right? It's a different business model. Mm-hmm. But the consumer is fine with them. Consumer wants that because they'll hit the easy button. They're not the ones who are panicking as long as they get a hold of someone. We want communication with each other. Hey, Emmanuel, I refer you all my business. I need you to pick up the phone when I give you a call.
In my world, there's definitely an emotional factor that is super important, which creates challenges for trying to systematize and remove myself completely from the business. It's almost like, and I was giving one of our agents this coaching this morning because he took listing and he's having some struggles with getting them from point A to point B on accepting that the price that they're asking is just not where it needs to be. And we were talking about, listen, you got to sit down with them. You got to have calls with them. You already know the answer. The answer is you're listed at whatever the number was. I think it was like $750. The right price is $700. You know that. You've told them that logically a bunch of times. Now you got to go meet with them, spend an hour with them, talk them through it, show all your logic, sit down, empathize with their situation. Then they're still not going to make the decision to change the price. Then a week later, after you've sent them all the feedback from everyone else consistently day after day, then you're going to sit down with them again. You're going to have the same discussion. We need to go from 750 to 700. See. Okay, then they're going to sleep on it. And then after you've given them love for so long, that's what we call it, giving them love. They eventually are just like, yeah, let's move to 700. You're like, oh my God, right? And that's super.
And then it's their idea. Yeah. And then you have to compliment them on, wow, this is very impressive. Yeah.
And I've tried this every which way. I've tried it let's just beat them with logic and beat them up with the feedback, but never go see them, right? It sometimes works, but it doesn't end in them loving me and wanting to refer me and or use me again. If I go, Joy's great at this, my mom, who's my partner, she's great at showing up. She's an old school, hugging the file all day, right? And she doesn't need to hug the file. All she needs to do is that little piece, which is go show up, and be in their face, give the personality, give the love, and give that emotional support. So that works. That's primarily the hurdle that we experience. But that is only necessary when you have a certain personality type, right? Like our personality types are all like, okay, let's just get from point A to point B. I don't need you to sit down with me. In fact, please don't sit down with me. I don't even want to see you, right? Like I got more things. We all have too many things to do to spend an hour at noon on Saturday just to get to the point that we need to drop the price because all the feedback's been telling us this, right? Like, don't even come over. Like, yep, I got it. Drop the price, right?
Yeah. I mean, on my deal, we've only had it listed a little over a week, but 3-4 days into it, I'm antsy. I'm like, Larry, when do you think we should drop the price? You're like, no, man, give us some time. But I'm like, let's just have a 2-minute conference call. Like,
exactly.
I don't need you to come over and hug me.
How low are you willing to drop it? What's the address on this thing?
Yeah, different personalities.
But yeah, different personalities. Plus, listen, it's also different if it's someone's home. They've lived in it for 10 years. They put their blood, sweat, and tears in it. They've had their children in it. They've, versus like we're dealing with a foreclosure flip investment property. I have no emotional attachment to it. It's all just numbers at the end of the day.
In fact, you were in there once maybe for 5 minutes.
Literally, yeah. Literally. Yeah.
Do you factor that in? So from a personality type, in terms of assigning who you assign on your team to work with,
Sure.
Jerron is on a disc test, he's a high S, high C. He's really detail oriented. Jared over here, to what you were just saying, no, just go direct real fast. Like he's going to make a really quick decision, don't cream puff it. Like, do you make those allocations differently based on initial call or personality feel?
Yeah, we have like a discussion about it, like post call, like usually. So whenever we do listing appointments, there's at least 2 of us. Sometimes there's 3 now. And when we walk out, it's like, oh, she likes you or he likes you better. They were vibing with the young guy. So Larry he's going to run point, or this is very much so a Joy person because Joy is going to be able to handle them personality wise. Whereas this is going to be painful for Larry to switch his personality around to manage this client and could end up in a bad situation. So we totally move it around for sure.
I mean, we're all chameleons. We all have the ability. I mean, that's why we're all sitting here, right? We all have the ability to adapt to personalities. But to your point, it's not, nobody wants to stay out of their lane or out of their comfort zone too long.
Agreed. Yeah. So that's a thing. That's 100%.
And it's just also the other person's perception of you. Maybe you're putting on your best emotional empathy. I'm the empath today, because the wife is very emotional or whatever it is, or maybe it's the husband who's emotional, but they see through the fact that you're still just more of an analytical kind of guy, but you're with your partner who or your mom, Joy, she's just warm and, she gives off that vibe, and it's because it's truly who she is.
Saying Larry's not?
Oh, man.
He's got a warm brain. Very warm. He's a smart guy. Very smart guy.
Some people see us through different marketing channels and they come in and they've already have a predetermined decision on who they want to work with too. Like they see a lot of my videos. So they'll just be inclined to talk to me directly, and Joy will be quiet the entire call just because she's not getting prompted with questions. They're just asking me because they saw, the past 5 videos that I put on YouTube or something, right? Yeah.
Yeah. That's kind of the modern interesting kind of phenomenon is that I have clients now that we've started this channel, and I've never met these clients, but they'll call me to ask a question, and they'll say, by the way, they start asking me about me and some things I've said because they've watched some of my videos, and I can tell on the phone that they feel they know me, but I've never met them once. It's funny how, just how that works. But
when you're a small business, I think the personal brand is highly effective at competing with these rocket mortgages as an example, right? Mm-hmm. I think that's our strength, showing our personality.
Yeah. We try to create systems and processes that are similar to theirs in terms of wanting to streamline things, wanting to be efficient, wanting to use economies of scale, all these different things. But we want to give it flavor. We want to give it personality. we've got to give it that human touch, and it literally everything, like we employ this 2-touch thing, which is if an operational person is speaking with a client, right afterwards, I want an email that recaps what it is, because the client might be at Publix pushing around the shopping cart, one kid in hand, the phone in the other hand, and 30 minutes later they forgot completely what you asked of them. And then for us also as a loan officer, I want to be CC'd on that email so that I know what happened. And then I start off, I don't even need to read the rest of the email. If it says, "Thanks so much for taking my call, Larry," that's the start of the email, so that I know, hey, perfect. So-and-so spoke to Larry. He's good to go. If you need me, I'll hop back in. But otherwise, I can kind of stay out of it.
Well, you all have really integrated. You're on the forefront of operations in the loan world, in the loan industry. You've integrated loan partners into your business, which not all companies have. In fact, probably a great majority of them do not have. And tell me if I'm wrong here, but I think loan partners have twofold advantage. One is internally for the loan officers. That allows the loan officers to keep focusing on more business, while the loan partner, after the loan officer has taken the app and had the first few introductory calls, then the loan partner can go and crunch all the data and grab the taxes and all their bills and everything else and the credit and process all that, so that the loan officer can go out there and keep selling and keep creating those relationships. And then on the flip side, from a customer service relationship, sure, the borrower and the realtor may call you and yes, have questions, and you'll be there to answer them. But sometimes you're busy or you're on the phone or whatever it may be. And that loan partner, who's your right-hand woman or man, and they're there to answer those calls, to integrate all of those kind of operations and answer those questions. Probably 95% of them can get handled by the loan partner, I would think, right?
Yeah. Well, there's also a third major piece of it from both a company standpoint and a customer service standpoint that they don't even realize is, a loan officer, just like a real estate agent, just like a title agent in a lot of ways, is first and foremost a salesperson. Try training a salesperson to do something that doesn't directly make them money, which is sales, which is to put a clean file together, to understand guidelines, to understand the way that it needs to be delivered to the next department. That's a losing battle 100% of the time.
It's 2 different personality types.
It is 2
Like
different personality
100%,
types.
yep.
You very rarely get somebody who understands how to have a conversation and sell, and then turn around and put on their analytical hat and do the work. But also,
4 unicorns right here, by the
well,
way.
listen, that's why we make it onto the big time networks like this. But
Yeah.
By the way, Emmanuel's the humble one.
Yeah.
I included you guys.
Oh, you're right.
No, but even so, listen, let's take all of us, for example. If you have some work in the file to do, but you have the next client calling you, all of us are going to put that work off till after that next client call. And what if there's a client following that and following that? And so ultimately, anyone in sales is going to do their highest and best use, which is more sales. That first client that came in the door is no longer getting your best foot forward. It just isn't. And so when you separate that, especially in our industry, that traditional function of a loan officer is not just to bring in business, but it's to structure the files, to collect the documents. It's to push it on through processing. It's to put out fires. It's to make sure that deadlines are hit. It's more operations than it is sales. Those are 2 different people. Every other business on the planet has this as 2 different people. Why wouldn't we? And so, yes, we started doing it really early on. And when we bring in, recruits from other companies that haven't had it before, they fight it a little bit, which is interesting. They hug the file.
Trying to micromanage it.
Oh, they want to do it all. Nobody
do it the way I do it.
Nobody can push a button like me. Nobody can print a document like me. Well, okay, let's pretend that's true. I bet you I got some people that can print a document pretty close to you. And that's not to demean the job. It's a super important job.
Sure.
It's just a different job. It's a different skill set. Mm-hmm. And so implementing that, and we've done that throughout the entire loan process, right? Is we put people in their highest and best use. And loan officers are there to sell. They're there to have the client experience be great. They're there to answer those questions. And we integrate them in key parts of the process to have those really integral touch points. And then our loan partners are there as their support, as their right hand, but more importantly for the client, they're the unsung heroes. They're the ones that are doing the work to make sure that that loan from day one to whatever closing day is beautiful and it's clean and it's easy and it allows the rest of our team to, look like superheroes to them.
And to your point, Jerron, the whole business model is if we strip away 60% of what you were used to doing, the time suck of the job, what are you supposed to do with that 60% of freedom that you have? In theory, you should now double up on your sales activities, your origination activities, go present to real estate classes, go have one-to-one with coffees with realtors, go meet builders, whatever it is that you need to do to originate. But now we're freeing you up to do, as Jared said, your highest and best talent, which should be your gift of gab, your ability to communicate with people and to be in front of people. And so for us, that's why we push it. We want, if everybody does exactly what they're supposed to do, we're an awesome machine.
Makes sense. You're putting all the right pieces in place. That's great. That's why it's a smooth running machine. So, listen, at all times it needs to be, greased a little bit here and there, as with any business.
That's just coffee.
That's great. Why don't you leave the audience with any last minute thoughts? Include in that, we're going to put your contact information in the description of the video, so they'll have that. But, kind of what next steps are if someone's a realtor, let's say they're a borrower here, or whether they're in Florida or Texas or North Carolina or wherever it is. What's what are first steps and how would you love to hear from someone?
I mean, I think in general, it doesn't matter how they reach out to us. We'll make sure that you guys have our cell phone numbers and our emails. I think for us, what we try to present and what I think is a great opportunity on here is for people to kind of to take a deep dive and understand who we are and how we think. And although I made a joke about being unicorns, we are unicorns in the sense that we are salespeople and we can turn on our charm and we can be, we know how to sell and we understand feature, benefit, impact, and all the technical aspects of a sale. But we truly have built in systems and processes so that everything from the client experience to the employee experience to the referral partner experience, and I go back to that, by the way, those are our core values. So it's why we go back to it. It makes it really simple to make all of our decisions and to make sure that everything happens the way that it's supposed to. So for us, whether it's a loan officer, whether it's a buyer, whether it's an investor, we welcome any conversations with anyone, whether we can help you or advice or anything there is.
Good. Jared?
Not much for me to add to that. You hit it right on the head, but to highlight and to bring back, our core values, as you said, referral partner experience, client experience, employee experience, and all of that. Everything we've talked about is really to get that, triumvirate of experiences to be as good as possible. And that's how you get your employees to give a little bit more. That's how you get your clients to have an awesome experience. That's how you get your referral partners to keep coming back and for it to just be that easy button. That's ultimately what we're going for all three.
I love it. We'll be pushing that easy button instead of Rocket Mortgage.
Yeah.
Good stuff. Larry, any last minute thoughts? Closing?
No additional comments.
Okay.
I'm
I love
great.
it. Yeah, good. Well, thanks for joining us, guys. I appreciate it. Yeah.
Thank you for the opportunity.
Yeah. Sure.
Awesome to be on here. So thank you very much.
And we'll be talking lots off air. Thanks for joining us today. And if you enjoy the content, please like and subscribe.